Hello again. Welcome back to part 2 of our module 4. We're going to do a deeper dive into analysis. And when we start talking about analysis, there is a famous method of computation called the Dupont Method. And yes, that's the Dupont Chemical Company, folks that created Teflon and nylon and even corian, has been around a long time. But they also actually older than me when the Dupont method came about. I think it was in 1914, 1915. You're saying, if it's that old, why are we talking about it? Well, accounting, as we know it, double entry accounting came about really in the 1600s, a guy named Pacioli. The Dupont stuff is actually pretty relevant right now as well. It's pretty current and it's timeless, we'll call it. It actually divides the methodologies and return on equity into what's called, as you know, return on assets, we saw in the last segment, and financial leverage, the ability to use somebody else's money. So let's do a little deeper dive, take a look at what we're talking about. So we've talked about return on equity. Performance analysis, we're wanting to find out what the drivers of those returns are. And the Dupont method divides it into 2 segments, which we'll see momentarily. In addition, there are 2 methods to measure ROE. So there's traditional Dupont analysis, which we'll again go further into. It disaggregates, it separates into profitability, productivity, and leverage. Those are the components that are broken down into. And the ROE analysis with an operating focus, we just talk about operating assets and operating income, and we'll talk more about that, and distinguishes between operating and non-operating activities. And as you recall on the cash flow statement, we have operating, which is the mainstream business, is what we do. We have the investing, which, we got to buy some assets or we invest in other companies. And then we have the financing, the debt or equity we take on to finance the operation to be profitable, to go in a direction that we want to grow the business. So we'll talk more about OIF. You remember the OIF, and you will always remember the OIF, hopefully, after this class, and we'll go forward. So let's look at this ROE separated. Now, return on equity, we know it's net income divided by average, again, average stockholders' equity. But if we use some basic algebra, net income over average total assets, return on assets, how about that? Times the average total assets divided by stockholders' equity. So if we have more assets and less equity, we get a larger number for leverage. So is that good or bad? Again, it depends. We're talking about acquiring more assets based on the level of equity. The financial leverage, again, is the term used, but that's the amount of equity invested and then to get the assets that we do get. You say, wait a minute, doesn't that mean average stockholders' equity? The only other thing missing is that liabilities portion. And yes, we've done that liabilities to asset ratio, the debt ratio, and the liabilities to equity ratio. But we're looking at financial leverage as average total assets over average shareholder equity. You say, wait a minute, didn't you tell me if it's on the balance sheet, I don't need to take averages? If it's just a balance sheet item, when I have an income statement item and a balance sheet item, obviously I have to take an average of the balance sheet item. But in this case, we do need to take averages because we are combining these 2 ratios, the ROA and the leverage, to go against the actual ROE to calculate ROE. So return on equity evaluates both the company performance and how assets are financed. Those are the 2 components. How are we financing the assets? Are we using investors to finance, or are we using debt to finance? Return on equity is higher when there's more debt and less equity. Okay, that kind of makes sense. More debt, somebody else's money, less equity, smaller denominator, we're going to have a higher return on that equity. But the trade-off, greater risk. If you have higher debt and less equity, you have less of a cushion to absorb losses if you happen to have them. And if you have too many losses, you're going to be in a deep hole. And then if you belly up, you close the doors, or you go into bankruptcy, the equity holders go away, the debt holders end up having access to the assets and becoming the equity holders themselves. So let's talk a little bit more about financial leverage. If we're looking at financial leverage, we're looking at the measure of relative use of debt versus equity to finance. We get assets divided by the average equity, average assets over average equity. It's important as debt is a contractual obligation. We got to pay the interest. So we can declare dividends whenever we want. We don't have to declare dividends, and many companies don't declare dividends, especially high-tech companies. But the idea of having debt, bonds or other notes payable or bank loans, those are interest dependent, especially on a startup. If you have a lot of interest expense, that can really put a drain on your resources. High financial leverage means higher debt and, as we just said, interest payments, and equals higher risk, probably a default and possible bankruptcy. To go a little bit further, let's look at our Boston Scientific, cool company. We're now taking our averages. Now, what went here? Remember, we had our average assets, and then we had our average equity. So 2.54. Is that good or bad? Again, it's a relative term. All these ratios, all these numbers are worthless when standing alone. I told you our net income percentage was 12%. Is that good or bad? If you said that was apples, that's bad. If you said that was Walmart or Target's, that's a thrill. That's fantastic. If you say a restaurant, that's actually pretty good. If you said it was a grocery store, which maybe is at 3-4% net income percentage, that's amazing. Is it good or bad to be higher? Sometimes it's not always good to be higher as a net income percentage. Maybe you got that by laying off half your employees, or you sold off half your business and you made a profit on that half of the business you sold off, but you're never going to see that again. So these are all relative. The number by itself is meaningless, but the number with comparisons to something else now has meaning. So what's the median financial leverage? About 2.66 in 2018, range from 2.46 to 2.74 from 2014 to 2018 on the S&P 500, again, Standard & Poor's 500. Let's talk a bit about preferred stock. ROE measures return to common stockholders. We're going to go a deeper dive on preferred stock when we talk about equity. But preferred stock is actually more like debt. It's guaranteed paying dividends. They get first dibs. They get first call on any dividends that are declared. So if you're a preferred stockholder, that's cool, and you're a common stockholder and the company declares dividends, you must pay off the preferred stockholders first, and then you can pay off your common stockholders. If you don't declare enough money and you're just able to pay off preferred, common stockholders get nothing. But we need to deduct the preferred stock stuff from our net income. Net income minus preferred dividends in the numerator, not regular common stock dividends, but only preferred dividends. By the way, not all companies have preferred stock. Average stockholders' equity minus average preferred equity. So we need to deduct the preferred equity as well. By the way, for those that are fans of IFRS, International Financial Reporting Standards, preferred stock shows up as debt. It's actually more like debt because there's usually a percentage rate attached to it. It's not real ownership interest. And as the note below says, preferred stocks get priority on dividend distributions, but they lose out on a bunch of other benefits. They're not really owners. They're not really voting owners. They're not really having ownership interest that allows them to elect the board of directors, for example. So that's why IFRS treats it as debt, even though GAAP does treat it as equity. It does show up in the equity section. So you'll be able to easily see that if it's present. But we do need to deduct that and have that out of the picture when we're calculating the return on equity. So return on common stockholders' equity. When we say ROE, we mean ROCE. So we're excluding the preferred dividends and the preferred equity that goes with that. So non-controlling interests, let's take a look, and we're talking about computing ROE. And so we take the numerator, net income attributable to the company shareholders. Preferred stockholders are not considered the shareholders, even though it just said preferred stockholders, right? Preferred shareholders, they're not your common stockholders. And the average equity attributable to common shareholders. So our return on equity is removing those items. Let's talk briefly about non-controlling interest, and then we'll cap this particular part of the module. Non-controlling interest and controlling interest. The public, to be on the Standard & Poor's 500, you can have 10% is the demarcation point, okay? So if you're in a position where you have less than 10%, available for public consumption, not a good place to be in terms of, you won't be on the Standard & Poor's 500 to be, but that's the problem that we are trying to isolate. There's some, maybe the family owns, they're not trading their shares, they have ownership interests, the founders, whoever it might be, they have their ownership interest. And then they went public and they let 50% of their shares go, half the company, 40% of their shares, 20%, 80%, 90%. Maybe they kept a small portion. So if they kept 95% of the company and they get 5% trading publicly, which can be done, they're not in the Standard & Poor's, but you also want to exclude the non-public component, or what's called the non-controlling interest, has to be separated. So when a parent company owns less than 100% of a subsidiary stock, so parent can own a company, but they don't own all of it. So they don't, not full consolidation. Must consolidate the subsidiary, add 100% of assets and liabilities to the balance sheet, 100% of revenues, expenses, that's a full consolidation. And then we need to modify the return on equity definition. So income attributable to the parent company over average equity attributable to the parent company. That's the non-controlling. They don't have control. Voting interests. So here we're taking a look at AT&T, American Telephone and Telegraph. We're looking at 2 years worth of balance sheet data. We're looking at 2 years worth of income data. And if you look down here, we have net operating assets. We'll talk more about that. And net operating obligations. We'll talk more about that. And just goes non-controlling interest, as well as the equity to go with that. Total equity is made up of both. So we make some calculations here. We're going to see this later on. This will take on additional meeting. All these terms, NOPAT, NNE. Yeah, these are terms we're going to want to know and be familiar with, but we'll see how those relate later on. But bottom line is we want net income attributable to the stockholders, the common stockholders, the folks in the public domain that are actually able to buy and sell on the exchanges. We're going to cut the second presentation, and we're going to go on to the third. So I'm going to stop it here. Thank you for your indulgence and look forward to seeing you again shortly.